Welcome back, guys. We're continuing on with our discussion regarding the four basic financial statements. And just for a quick review, remember the first financial statement is the income statement. The second statement that we talked about was a statement of cash flows, and as we mentioned, cash is like oxygen for a business, so if you don't have it, you don't exist. And now we're going to talk about the third one, just in terms of review, the statement of owner's equity, which basically reflects the monies that have been paid in by the owner of the business. It reflects his or her equity ownership in the business. Now, the next statement is probably one of the most important in the world of accounting, and that is called the balance sheet. Now, the reason this is so important is it reflects essentially what the business is doing from an asset standpoint, meaning assets are things that you own and can use to make money in your business, as well as from a liability standpoint, which, as we talked about before, is primarily obligations you have to pay people. So let's kind of just move through here. Now, you see the term current assets and current liabilities. An asset or a liability is considered current if it is due within 1 year, a year or less. It is considered, an asset is considered long-term if it is due in a year or more. So if we go down the asset side of the balance sheet, we have current assets, and obviously cash is an asset. There's some short-term investments here. Accounts receivable, essentially that is monies that are owed you by someone. If you sold something on credit, they would become an accounts receivable. It's like an IOU. Inventories is considered a current asset. Inventories would be your merchandise or products that you have stored to be sold, and then prepaid insurance, which basically means you've made a payment in advance for some insurance. Then you have long-term, which means something that would come due in more than a year. Stock investments is considered a long-term asset. Cash value of insurance would be considered a long-term asset. And then things like property, plant, and equipment would be considered long-term assets. Now, intangible assets are things that essentially are not tangible, meaning you can't touch them, feel them, or smell them, but they have value. Like your brand name might be an intangible asset, and that usually is classified as goodwill. And then we have other assets down here, and a total of $910,000. Now, if we move over to the liability column, we have the current liabilities. Accounts payable basically means people owe you money. They're going to pay you in less than a year. Salaries payable. I'm sorry, I said accounts payable. People owe you money. That's accounts payable is where you owe someone money. So that if it's a current liability, that means that you have to pay that within a year. Salaries payable would be salaries that you owe your workers. Interest payable would be interest that is due on a loan or some type of note. taxes would be taxes that would be due. So those would be considered current liabilities. Then we have long-term liabilities, and usually long-term liabilities are loans. Sometimes loans are called notes, sometimes they're called bank loans, sometimes they're called mortgage obligations, but these are something that would be due in a year or more. And then the last part is what's called stockholders' equity, and this relates to that owner's equity statement that we talked about earlier. And this reflects the stock that has been issued as well as any earnings that have been retained in the business. But kind of the cool thing about the balance sheet, and that's why it's called a balance sheet, is if you add up current assets, long-term investments, property, plant, equipment, goodwill, you get $910,000. And if you do the same thing from the liability standpoint, current liabilities, long-term liabilities, stockholders' equity, you essentially come up with $910,000. So on a balance sheet, your assets should always equal your total assets should always equal your liabilities and stockholders' equity. Okay, we've now covered the four basic statements. The auditor's report is basically just that. It's a report that is issued by an accounting firm, which is sometimes called an auditing firm. And the reason these are important is, again, as an investor in a business, you want to make sure that the accounting statements you're looking at are actually true and accurate and represent fairly the performance of a given business. Well, an auditor comes in and essentially examines all the accounting records and determines if the accounting records follow generally accepted accounting principles. If they do, or if they don't, the auditing firm issues an opinion, which basically says, hey, these guys are doing a really good job in terms of their accounting for their business, and they are following generally accepted accounting practices, or they're not. They've got some problems, guys. But this is the critical part of the accounting information cycle, and very important. All right, guys, we will end it here. Please make sure you've taken good notes, and we will be discussing this and taking a quiz on this section of the video tomorrow in class.